Okay, good afternoon once again. Today we're going to continue our discussion on ratio analysis. By way of a quick review, so far we have learned that to evaluate the financial performance of a firm, we have to compare it with a direct competitor or we have to compare it with time. What has been happening to a specific ratio, a specific metric over the years. Okay, there's a request here. Migs, can you post the dates, the time, and the coverage sa Canvas to avoid confusion? Yes, Migs, we'll do that. Okay, pero i-post ko na muna dito. No? So let me first pause recording. Okay, we learned how to compute for the common size statement. When we say common size statement, the name is very suggestive. It means that we are benchmarking or we're comparing all the other values to a common account. For the income statement, that common account is sales. And we learned how to use one formula, right? Just one formula and copy to all the years to generate our common size statement. For the for the balance sheet, everything is benchmarked against total assets or total liabilities and equity. For the horizontal analysis, we're comparing year on year or month on month, depending on the dates of your financial statements. But this one, this 70%, the formula of this is the current value divided by the present current value divided by the previous value minus 1. Okay, the 70% here indicate that sales grew by 70% from 2019 to 2020. Okay, so these are figures where we can infer the performance of the firm. But these are just all internal values. This is comparing with time. This is comparing with a certain benchmark. Okay, we need to also compare with the direct competitor. Okay, notice I said direct competitor. It's not just any company in the industry. Dapat direct, no? Okay, so I hope you recall what direct means. It's a company which targets the same, which has the same target market as your company. For example, Jollibee, hindi niya target market, not necessarily yung customers ni, let's say, Burger Machine, no? Hindi. Iba yung target market ni Jollibee. Okay, although some customers of Jollibee could also be customers of the small food outlet Burger Machine. Pero ang direct competitors ni Jollibee would be, safe to say, it would be McDo, no? Kasi pareho silang target market, pareho silang niche, no? So a direct competitor is one who has the same target market as your company. All right. And again, sa online quiz natin, kasama itong mga metrics na to, no? In particular, sabi natin, EVA is a very powerful metric to see if the company has created value for their shareholders, economic value added. If it's positive, then value was created. Otherwise, like in 2020, it's negative, so value was destroyed. We also learned about the free cash flow. Okay, the amount that's available for distribution to investors, aka your shareholders or creditors, after removing or after deducting investment in operating activities. In this case, the formula is NOPAT minus the net investment. So the free cash flow, unlike the EVA, it can be negative, and yet the company is doing well. Okay, if the NOPAT is okay, and the free cash flow became negative because of a high net investment in TOC, that's okay. However, if the FCF is negative due to a very low NOPAT, then that could be a bad free cash flow. But a high net investment in TOC will be good. An investment in total operating capital in order to support the sales goal of the organization is very good because assets in general, operating capital, which takes the form of operating current assets and operating current liabilities with the operating long-term assets. They are very important in supporting the sales goals of the organization. Okay, so we continue our discussion and we go on to this one. We said that liquidity, we said that financial ratios help the firm assess how it has been doing so far. And there are five things that we're looking at here: liquidity ratios, asset management, debt ratio, profitability ratios, and market valuation. Okay, so most probably we'll not be able to finish this, but definitely by next Tuesday we'll be able to cover everything here. Okay, everything here. So on Friday, the first hour will be the quiz. It will not include this, kasi financial ratio analysis to. Ang kasama sa quiz on Friday will be time value of money, but this will be covered in next Wednesday's online quiz. Okay, so let's move on to this one. Okay, so last time we said that the current ratio tells us the capability of the firm to pay its current obligations. Unlike yung solvency, ang focus nito on long-term obligations. So each peso of what's the meaning of current ratio? For every 1 peso of current asset, the company has for every 1 peso of current liability of an obligation that will become due that operating period, then the company has 2.58 pesos of current assets, and they pale in comparison with the direct competitor. However, we said that we don't stop here. We have to look at the nature of the quality of your current assets. Kasi baka yung current assets natin, marami doon inventory, no? Kapag inventory kasi mas matagal muna ma-convert into cash yun. So that might make the company experience shortage of cash in paying off its current obligations. Now, the quick ratio is more, shall we say, strict as far as the measurement of liquidity is concerned, because it only includes the first 3 items in the current assets: cash, marketable securities, and AR, receivables, because these are the most liquid of your current assets. So relatively, cash, of course, it's already cash. Marketable securities is very easy to convert to cash, and depending on the nature of the business of the company, receivables could also be easily converted into cash. But of course, it depends on the nature of the business of the firm. All right, and it turns out here that the quick ratio is 0.93. Okay, almost at par with the current liability. The competitor has 1, which means that for every peso of current liability, the company has 1 peso exactly for its to pay its current liability. Okay, then let's go to inventory turnover, ITO. Okay, the inventory turnover is a very important metric to assess the performance of the firm operating wise. So what does this tell us? The inventory turnover is the number of times, so let me write it here. Let me just use this. Okay, ITO. Oops. ITO. Okay, so it's the number of times a company buys raw materials, converts to finished goods, and then sell. Yeah. From the buying of the raw materials up to selling. That's 1 cycle. Okay, another cycle, another cycle. Okay, so the number of times a company is able to convert raw materials into finished goods and then sell, that's your inventory turnover. Okay, that is your inventory turnover. So for inventory turnover, the greater the value, the better. Okay, if inventory turnover is, let's say if a company has 10 times for its inventory turnover compared to 4 times by their direct competitor, then we can say that the company with the 10 times inventory turnover is performing better because the velocity of its operations far outclasses the competitor. Kasi kung 10 times siya, tapos si competitor nila 4 times lang, talo si competitor kasi the company is able to convert the raw materials into goods and then sell. This is up to selling. Sell, and then another cycle, sell, another cycle again, sell. Okay, so in this case, the company is able to do that 3 times. Okay, so let's take a look at the formula of the inventory turnover. And the formula is cost of goods sold divided by average inventory. Now, take note, this is an income statement account, cost of goods sold, which means this was taken over let's suppose that 1 year period. Okay, itong cost of goods sold nila. Okay, assuming that this is a yearly, the income statement and balance sheet here is for the year 2021, 2020, etc. Now, when we divide it by inventory, take note of this ratio, turnover. Whatever we turn over will be your denominator. So inventory turnover, how many times are we turning over inventory? Okay, so let's get the formula for this. This is equal to cost of goods sold. So let's copy it from above, divided by, we now have the average. Okay, I'm able to get that. Average of your inventory. Okay. All right, so that's the formula for our inventory turnover. You have your cost of goods sold divided by the average of your inventory. Okay, and then we can now copy this to the right. All right, kindly chat please if you were able to get the values for the inventory turnover. Okay, thank you. 4.68, Rafi, saan? 4.68 sa 2021?
Sir, for the, oh, sorry, sir. We have to do pala the 2019 also.
Yeah.
Hold on, sir.
What did you get as 4.68?
Sir, for 2019.
2019. Okay. Kasi wala tayong 2018 for 2019. But nevertheless, I still got the average of E21, F21. Wala tayong F21 eh. Okay, but still, if it gets the average of this one, it will still be 715, 200. So that should be, okay, let me highlight this. So it's still 715, 200. So even if the previous figure did not have any value, okay, the average of 2019 and 2018 is still 2019. Okay, so you should be getting 4. Kindly check your formula, Rafi. It's E5 divided by average of E21, F21.
Okay, sir.
Okay, did that address your question?
Sir, sorry, can you flash the
Formula?
You did the formulas again.
For 2019?
Something wrong with the input.
For 2019?
For all, sir.
For all, sige. See, kinapit to the right ko lang to, ha? So for 2021, it's C5 over the average of C21, D21.
So because that's the average of the inventory.
Oh, yes, average of the beginning and ending. Kasi di ba sabi natin dito, cost of goods sold is a metric, it's a value that's computed for the whole year. Kinocumulate yun, no? They add the total cost of goods sold for the whole year. Tapos si inventory, it's a figure that's a point in time. Kung balance sheet yan, diba? December 31 lang yan. So parang may mismatch. Dapat, ang gagawin, kukunin natin yung average, beginning at saka ending. That's why we're getting average of C21, B21.
Okay, sir. Sir, I got it now. I was able to
Okay.
get the right numbers.
All right, good. Thank you so much. Okay. All right. Any other questions? I appreciate your questions, class. Keep it coming. I appreciate the honesty. Kung hindi nakukuha yung answer, and that's a very good practice. All right. So let's take a look at the inventory turnover of our company. Assuming we're part of the company, so you can see that 2019 4, and then in fact 2020 proved to be better kasi parang mas mabilis yung inventory turnover niya compared to 2019. And yet, yung performance natin ng 2020 as far as net profit is concerned, negative to, di ba? 2020 was a very, very challenging year for the company. They had a net loss, 95,136. And yet, so there's so many things we can, if you're with the company, you have to really dig deeper. Why is this? That the company was able to turn its inventory around faster than 2021, in fact, faster than 2019. And yet, it was suffering losses. So that's one thing that finance or the other part of management should look into. So comparing 2021 and 2020, 2020 proved to be a better year kasi 4.97 yung turnover niya, almost 5 times. So every year, it was turning its inventory from raw materials to finished goods and then selling, almost 5 times a year. Okay, maybe let's make this just 1 decimal place. Okay, so I just made this 1 decimal place, no? 3.9, 6.1. But in terms of its relation to the direct competitor, 6.1 yung direct competitor, no? So if we take a look at what's happening, so this is the ITO of company A. Let's suppose company A is our company. And then if we compare that with company B, so this is company B, let's make it a different color. So this is company B. And the same timeline, no? The same timeline. So see our company is one time, once, okay? This is another time, twice, thrice, okay, and some fraction here, right? To account for the 3.9 times, almost 4, okay? Almost 4, let's put it here. So this is 0.9 times. So our company was turning over our inventories 3.9 times, while our direct competitor was doing it 1, 2, 3, 4. Okay, sorry for 5. Let me remove this. Okay, so this is 1, 2, 3, 4, 5, 6 times. Okay, so this is 6 times. We are doing it 3.9 times. Okay, in that regard, who is the better performer? Plus, kindly chat, please. Which is the better performer in terms of inventory turnover? A for our company and B for the direct competitor. I'd like to hear it from you, class. Which is the better performer in terms of churning, in terms of turning over the inventory? Buy raw materials, convert to finished goods, sell. Yeah, I know, please. which is the better performer? Is it company A or company B? Okay, let's wait for the others to answer. Thank you, Raf. But how about the others? What's the response of the other of our classmates? Class? In terms of ITO, which company was performing better? Si A ba yung company natin or si B yung direct competitor? Our company had 3.9 times, B had 6 times inventory turnover. Okay, let's give a few more seconds to your classmates. Okay, we hope we can reach 90% response rate. 90%, that's around 30. Okay, thank you so much. All right. Okay, my question dito, Alexa, yes. Alexa, kindly share your question, please, to the class. Alexa, okay. So there's this question of Alexa. The higher the ratio, but the better, yes. In terms of inventory turnover. Why is it the higher the better? Because it speaks of the velocity. It speaks of how fast the company is able to turn around on its inventory. Okay, which means buy raw materials, convert to finished goods, and then sell. So the more number of times you do this per year, the better for the company. Okay, so we can see that our competitor turned over its inventory 6 times, while we turned over our inventory only around 4 times. So they were faster in terms of churning churning the finished product and then selling. Okay, 4 times tayo a year, sila 6 times. Okay, all right. So just by way of review, for inventory turnover, the higher, if we're benchmarking, if we're comparing, the higher the inventory turnover, generally the better for the company. All right, then we go to ARTO, accounts receivable turnover. And what's the formula for ARTO? It's your sales divided by your average accounts receivable. Again, we're going to get the average. Okay, ARTO is accounts receivable turnover. Average class, average AR, because our sales is a period for the whole year. So this is a balance sheet. So what you can see in the balance sheet is only for that specific point in time. So in order to make it a little bit more comparable, then we get the average AR instead. So this gives us your sales for 2021 divided by the average accounts receivable. Okay, so I'm getting a 9.3. Copy this to the right. 9.3, 11.9, and 9.8. Okay. So first, taking a look at it year on year, again, 2020 seemed to be faster in terms of collecting on our receivables. Okay, it seemed to be faster in terms of collecting on our receivables. Kasi in 2020, we were doing this around 12 times per year. In 2019, it was around 9.8, while in 2021, it went down even to 9.3. It means we were slower as far as collecting on our receivables. So the company has to analyze this. Is this due to failure of the collection department? Maybe the company does not have any collection department. So maybe nobody is really in charge of the collection. Maybe that's usually the accounting also, no? Magpa-follow up lang sila. Pero wala, no active role as far as really collecting on their receivables. Okay, and then there are studies that show that this is very critical because if the company is not able to collect on time, and also the company might be suffering from uncollected accounts, bad debts, okay, then that that can affect really the financial performance of the company. Of course, if the company is not able to collect, then due to very poor collection policies or collection practices, then that spells bad for the organization. Kasi sayang, remember, kasama dun sa nabenta dun sa ng company, andyan yung raw material cost. Andyan lahat ng cost, labor cost, andyan overhead cost. Kasama lahat dun. It's part of that finished goods. Plus the markup, okay? If the company is not able to collect that, there goes that amount. Okay? So 9.3 versus 16. So let's draw that. So let's take a look at our ARTO. So our ARTO, accounts receivable turnover. And what does the ARTO measure? It measures the number of times a company collects. Number of times company collects on their receivables. And just like ITO, the higher the ARTO, the better. Because that means that the frequency that the company is able to collect the receivables is more. Okay. All right. Mon, yeah. Okay, sige. Thank you for that question. There's a question here on the ARTO. Okay, let me flush the ARTO. Okay, guys, I appreciate you asking questions. I'm really happy with it, no? Because it means you're interested, no, to know why you're not getting the figures. Okay, it's C4. So what's C4? This is your sales. Sales divided by the average receivables here, 20. Okay, so let me flash the formula again here. So C4 divided by the average of C20, D20. Okay, and then just copy the formula to the rent. Rambik, were you able to get it? Got it ba? So ito, kinopy lang natin. So this will be D4 over average D20, E20. Okay, thank you. Thank you for those questions. I really appreciate, again, guys, those questions. Okay, any other questions as far as the ARTO is concerned? Okay, so balikan natin yung sample natin, 9.3 times. Okay, so that's that's how fast we're collecting on our receivables. Okay, drawing tayo ng timeline. Again, timeline natin. So this is 1 year. So si direct tayo, ilan tayo? 9.3. Okay. After selling, we collect 1, 2, 3, 4, 5, 6, 7, 8. Sorry for the 9 something. Okay? Let's assume dapat pareho yan, yung length nitong line na to if it's 1 year. So tayo 9 point something. ARTO natin 9.3 times. Right? Yeah, 9.3 times. However, our competitor is 16. So same thing here. 1, 2, 3, 4, 5, okay, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Sorry for the approximation. So ito, no? Yan. Yan yung cycle ng direct competitor natin. Diba? You can see here, they're very fast as far as their collection is concerned. Okay, while our company is only 9.3 times, our direct competitor is doing it at 16 times. Okay, and as I said a while ago, ARTO, the higher the ARTO, if you're comparing among companies, the better it is because it means that the company is able to quickly collect on their receivables. Okay, let me pause for a while. Okay, again, this question. So far, ITO, ARTO, are we clear on that, guys? ITO, number of times a company is able to convert its goods, its raw materials into finished goods and then sell. Si Arto naman, from the time it takes the company to sell, from selling to collecting. Okay, I only have 2 responses. How about the others, class? My question is, clear ba siya? So far? Clear, boss. Thank you, Mon. Okay. Okay, good. Good. So thank you for your responses. All right. Then we go to Apto. This is accounts payable turnover. All right, thank you. And Apto tells us how many times a year, okay, do we buy raw materials on account and then pay. So this has something to do with our payable, buying from our supplier and then paying. And the formula is cost of goods sold divided by average accounts payable. So let's do that. So our formula is equal to cost of goods sold, this one, divided by the average of your accounts payable. Our accounts payable is this one, there. Okay, 17, let's copy this to the right. All right. So we can see here, 19.7, 21.2, 17. So let's interpret this 17 vis-a-vis 13. Okay, I think I made a mistake here. Can you please make this 10? May mali yata ako dito. I'm sorry about this. This is 10. Okay, repeat the formula. Okay. The formula for Apto is, so C5, this is your cost of goods sold divided by your average accounts payable. Okay, and what's the definition of this? Okay, this is 17 times. Let me just flash this formula so that you can see what the average for 2019 is. 17, what does this mean? It means that it's 17 times. So this is the number of times a company buys from their supplier and then pay. From the buying of the raw material or the goods up to paying the supplier. Okay, it takes the company around 18 times or 17 times per year. Okay, Migs, does that answer your question? Are you referring to the formula? Migs. Okay, thank you. All right, any other questions, class? Okay, no questions? All right, let's compare 17 and 10. Okay, let me go here again. So this time we're looking at the Apto. So Apto naman tayo. Ano ibig sabihin ng Apto? Accounts payable turnover. So let me once again use this. So Apto, number of times a company buys on account and then pays its suppliers. All right. So once again, we draw this. Oops, sorry for the color. Okay, so for our company, it's 17 times. So buy raw materials, pay once, 2, 3, 4, 5, 6, 7, 8, 9, 10, etc. So this is 16, 17. All right, 17 times for our company to buy raw materials and then pay. All right, let me see. I think we have a question here. All right, may question ba? Okay, I think I saw a
Sir.
Yes, okay.
So it's like the other ratio, so the higher the better.
Yes, Sa ITO, the higher the better. Okay, the higher the better. Arto, the higher the better. But for Apto, okay, sige, I'm going to ask a question. No? Okay, our competitor was doing it only 10 times. No? So parang mas mabagal sila. Mas mabagal sila magbayad. Okay? So my question is, our direct competitor was doing it 10 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay? 10 times. While we were doing it, ilan tayo? 17 times si company A versus company B, which was doing it 10 times. Okay. All right. Paki-chat please, A or B. In terms of Apto, which company was performing better? Okay. So may I have your idea about this or your opinion? What do you think? Our company was moving our payables 17 times while our direct competitor was doing it 10 times. So what do you think, class? Which company was performing better relatively in terms of Apto? Okay, Rafi, yes, your question, please.
Sir, I'm not sure, but I think you can argue. Maybe you can argue that B is doing it more efficiently
Okay,
because the sort of like maybe if you can create the situations like they bulk all their orders in one, so that they buy on account less, but they're still paying their suppliers back.
okay, all right, okay. Yeah, that's a potential scenario. So what's your answer? Is it A or B?
Sir, I'm not sure, but I guess I'll go with I'll go with B.
Okay, thank you. All right. So the others answered A. Okay, there are some who answered B. The higher the ratio, the quickly they pay off the debt. Okay, that's a good question by Alexa. All right. So, uh, okay. The answer here, class, is okay. Let's postpone the answer. Okay, let me link this to this Apto is related to DPO. Okay, DPO stands for days payable outstanding or average payment period. So APP. Okay, please take that down. DPO stands for days payable outstanding. Let's see. Days, let me write that. Payable outstanding. Outstanding, I'll just put OS, okay? Or accounts payable. Accounts, oops. Accounts APP payable period. Payable period. All right. So this is what this stands for. DPO is days payable outstanding or accounts payable period. All right. And another way to look at your APTO, accounts payable turnover, is by looking at the DPO. Okay, and the DPO is just, so let's put here the number of days, operating days per year. So let's put here in line 55, operating days per year. Okay, let's assume that the company operates 365 days a year. Okay, ibig sabihin, Pasko man o holiday, they're still operating. Maybe they're in a very critical business, like for example, hospitals. You don't see hospitals closing, right? If there's a holiday. In fact, if there's Christmas, they're still open, especially in New Year. Okay, to meet the New Year, guys. Hospitals are on the alert even because of possible injuries due to the New Year revelry. Okay, so there are some businesses like that. There are some industries like that. Regardless of holidays or not, floods or what, natural calamities or what, they still have to be open. Okay, and the formula is just 365, which is our operating days. Okay, since okay, let's do this to make it a bit easier. Since this is okay, let's just give this a name, operating days. All right, I'm giving it a name, operating days, this one, so that we can copy it below. All right, so this is, we'll start with this one, is equal to operating days. Operating days divided by, so take note, divided by Apto. So it's just like the turnover of the of the Apto. All right, 21.5 days. Let's copy this to the right. Okay, so what can we see from the formula? Okay, 21.5 days. Let's now go back to our illustration. So this one, each of these times is actually 21.5 days as far as our company is concerned. Looking for, okay, so this is taking a look at Apto. This is 21.5 days. This one cycle here. So this is another 21.5, another 21.5. So each of the 17 times account for 21.5 days. Wait, why is this not changing? Sorry. I was using the, okay. Okay, sure. Let me show the formula again for DPO. Okay, once again, guys, I really appreciate your questions. Thank you so much. Okay, for the DPO, what I did was to give a name to the operating days since they're the same for all the years. So it's operating days divided by C97 is your Apto, 17. So you're, in effect, the number of times is being converted into the number of days. Okay, so if you're doing it 17.5, 17 times a year, what is the interval between days? So you just divide 365 days per year divided by the number of times you're doing it, right? So that would mean it's 21.5 days. Okay, 21.5 days, which, you'll have 21.5 days 17 times per year. So this is what this means. So each cycle, each one time here in this 17 is equivalent to 21 days. Okay, Raf, did that answer your question? Okay, thank you. Thank you once again, guys, for those who ask questions. I really appreciate that. Okay. All right. So for our competitor, since it's only doing it 10 times, okay, how long does it take our competitor to buy the raw materials and then pay? How many days? So the days payable outstanding, of course, it's measured in days. So this, on the other hand, is 36 days. So each of this is 36. This one is 36, 36, etc. Okay, now question. Okay, which is the better performer? Okay, technically you might think that it's A because it's able to pay ahead of faster than company B. But this is not what this ratio tells us. This ratio tells us that it takes company B to pay 36 days, which means most probably they have better terms. They're given better terms by their supplier. Okay, as compared to company A. Perhaps company A defaulted in its, perhaps it was given a good terms before, but because they defaulted on one of their of their credit, then maybe it was reduced. Okay, we have to know the whole story. But this is telling us that it takes the company B 36 days to pay. Okay, so they provided longer terms for their payables. So that means that perhaps the supplier trusts them more, and having a longer term provides a competitive edge for the company. Okay, because if they're taking some time to pay their obligations because of better terms, then they can do something with the cash first, compared to 21.5 days vis-a-vis 36 days. So for R2, the lower, the better. If the R2 is lower, then it's better like this, 10 times versus 17 times. Because the CASIN, quote unquote, CASIN metric for Apto is your average payables period, average payment period, or days payable outstanding. Okay, and the opposite is true for APP. For Apto, the lower the better, but for APP, the higher the better. Why? Because it's indicative of we getting better terms with our supplier. Okay, so the answer to that question is company B was faring better by virtue of the lower Apto or by virtue of the higher APP. Higher APP here, 21.5 days for A and 36 days for company B. Okay, better terms. Okay, longer APP, longer DPE. DPO means better terms. Assuming that these companies pay on time. All right. So again, let me pause for a while. Any questions, class? Is it clear so far? Okay, let me. Are we clear on the concept of DPO and your accounts payable turnover? Up to? Okay, good. Thank you. So round 2 for the solution. Okay. Are you referring, Vic, to the to the formula or to the here? This one? Okay, for the DPO. Okay, so the formula is, okay, it's the operating days. Where did I get the operating days? I placed here a cell, okay, 365. The same for 2020 and 2019. Actually, we could have used this formula, 365, but I decided to give this a name, di ba may pangalan to, operating days. So when we use that, this one, operating days divided by accounts payable turnover. This one. Okay, Vic, are we okay? Alicia? Are we okay with the formula for DPO? Okay, thank you. All right. So we were able to compute for the days payable, okay, days payable outstanding, or this is accounts payable period. All right. Now let's go back to our measures of ITO. So the CASIN of ITO is days inventory outstanding. Okay, so they actually mean the same thing, only that the ITO is measured in terms of number of times per year, while DIO is measured in terms of days inventory outstanding. So we can also use the operating days divided by the ITO, this one. There. Divided by the ITO. And we get 94.5. Copy this. This is also equal to 36 operating days divided by the ITO. All right, 59.8. Okay, so let's go back to our ITO. The equivalent for our company is 95 days. The approximately for our direct competitor is 60. So 95 minus 60. Let's take a look at our ITO. So since ano lang tayo, 3.9 times, that means mga 95 days to. So this is 95 days. For our company, this is 95 days. This one. This is 95 days. And another 95 and a fraction of 95 days. 95 times 0.9 because this is 0.9. Okay? While on the other hand, our competitor is able to do this. This is 60 days, 60 days, 60, etc. 60, right? So if in the ITO, the higher the better, okay? The cousin of this is the days inventory outstanding, DIO, or accounts inventory period. Okay? The lower the better. Okay, opposite sila, no? Kasi you're dividing ITO sa formula, it's the operating days 365 divided by ITO. Diba? So if this is the higher the better, then naturally this one should be the lower the better. Kasi denominator yung ITO natin, no? Okay, and from a practical perspective, ito, buy raw materials, convert to finished goods, sell. 60 days lang. 60 days, 60 days. After every 60 days, our direct competitor is able to do that. Tayo, okay, nakatapos na si competitor ng isang cycle. Okay, after 30 days, kalahati na siya dito, no? Tayo hindi pa nga natin nabebenta. Siya nagsa-second cycle na siya. Okay, so this is how glaring the difference in the performance of our direct competitor and our company. Okay, taking it from the days inventory outstanding, on the average, we were doing the process of buying raw materials, converting to finished goods, and then selling 60 days on the average. 60 days natin nagagawa yan. I mean, the competitor. No? Tayo 95 days. So, obviously, sino mas magaling? No? Kaya nga 3 beses lang tayo nakagawa, almost 4 times lang tayo nakakapag-cycle ng ganito. No? Kasi it was taking us long. While our competitor would do this 6 times a year. Kasi mabilis yung velocity ng operations. Okay? All right, so that's for the ITO, the higher the better, or the ARTO, the lower the better. And we expect that, of course. Kung mas mataas yung ITO, definitely, if you're comparing two values, mas mataas yung ITO ng isa, definitely, yung DIO nun, mas magiging mas mababa. And we would want that ITO to be very high para mas mabilis, or AKA, also known as DIO, which we want to be lower. Para mas mabilis yung number of days na nagagawa natin yung tina-turn over natin yung inventory. Okay, next. Okay, let me pause for a while. Sorry. And ask everyone if clear yung tandem ng ITO at saka ng days inventory outstanding. ITO and days inventory outstanding. Kindly please chat if it's clear. Okay, isa lang. Okay, waiting for the others to respond. Okay, good. Thank you so much, class, for your responses. I really appreciate yung responses natin. Okay, very good. Okay, let's now go to DSO. Ito naman ang partner nito, si Arto. Sabi natin si Arto, the higher the better. So we are outperformed by our direct competitor kasi 16 sila, tayo 9.3 lang. 9.3 times lang tayo, sila 16 times na from sales nako-collect nila. Sales to collection to. No? Okay, so let's see. The cousin of Arto is days sales outstanding, and as you guess, this is operating days divided by the Arto. Alright. So ganun din to, operating days divided by the Arto. Okay, what can we see here? Wait, tama ba yung formula ko? The day sales outstanding, operating days, mali, sorry. Hindi, tama. Arto, tama to. Ito naman, operating days divided by Arto. All right? So let me see my question ba dito. Okay, clear. Thank you. Okay, so take a look at this, class. Day sales outstanding. 39 yung company natin, 22 yung competitor natin. So tingnan natin day sales outstanding natin. Here. Di ba tayo, ang Arto natin 9.3 times? So if we convert this into days sales outstanding, it's taking us how long? 39 days. Day sales outstanding or average collection period. 39 days to. So this is natin ang yan, may 39 days. 39 days. So bawat cycle 39 days. On the other hand, our direct competitor is taking them around 23 days lang. So 39 days over 23 days. What's this? The number of days it takes us from the sales on account up to collection. So mas mabilis tayo nakakapag-collect versus mas mabilis yung competitor natin nakakapag-collect versus our company. So again, this should beg the question to the company. Why is that so? Palpak ba yung collection department natin? Or wala ba tayong collection department? Wala ba ang naka-assign talaga na nag-monitor ng receivables natin? Okay? So why are we being outperformed by our direct competitor? Kasi sila 23 days. Tayo 39 days. So medyo malayo, no? Medyo malayo yung performance natin. Okay. Now, it brings us now to this operating cycle, very important for operating cycle, which is our DIO, which is days inventory. How long does it take us to buy raw materials, convert to finished goods, and then sell? Plus, how long does it take us to collect on the receivables? Okay? So, ang tawag dyan, operating cycle. From the start, from getting the raw materials, converting to finished goods, and then selling, it takes the company 140 days, 134 days. Okay, 134 days. Yung competitor natin, 83 days. Tingnan natin yun. So let me open a new worksheet. Okay, you can see the disparity. No? Ito yung timeline. So it takes the company around 133 days. So itong buong cycle na to, 133. Okay? So this is called also the operating cycle, which is your days inventory outstanding. So ito yung DIO natin plus the DSO. 133. 133 lahat. So this is called also the cash to cash cycle. Cash to cash. Bakit cash to cash? Naglabas ng pera, okay, para makakuha ng raw materials, etc., gumastos, and then makukolect dito. 133 days. On the other hand, our direct competitor is doing it for how many days? Ilan? 83 days. Diba? 83 days. So, DIO nila and DSO, pag inad natin yan lahat, 83 days. Okay. 83. Tayo 133. Okay? Ibig sabihin, plus 50 days pa bago natin makolekta. Nakapag 50 days ulit sila bago natin makolekta yung receivables natin for our first cycle. So we can see here the disparity between the operations of our company and the direct competitor. Talong-talo tayo, no? Ang bilis nila, on the 83rd day, tapos na sila eh. Okay, tayo, 133 days pa lang. Okay? All right, and the last, we have a few more minutes. The last ratio is this one, cash conversion cycle. So dito sa operating cycle, kita natin, very important to, no? So operating cycle, the lower the better, no? Kasi ibig sabihin nun, ang bilis ng velocity ng operations natin. Bili tayong raw materials, convert to finished goods, sell, and then collect. Okay, ang bilis. Okay, well, yung competitor pala, no? Hindi tayo. 134 days tayo, yung competitor 83 days. And then what's the cash conversion cycle? We'll end here. The cash conversion cycle is operating cycle minus DPO. Okay, so let me just run that. Is equal to your operating cycle minus your DPO. Or in other words, this is your DIO plus DSO, diba? Minus your DPO. Okay, so yung competitor natin 46 days. Tayo 112. Okay, let me illustrate what this means very quickly. All right. So, ano yung operating cycle natin? Our operating cycle is 134 days. Ano yung days payable outstanding natin? Class, what's our days payable outstanding? DPO is 21, okay? 21. Or sabihin natin 22, no? So 21. 22. Okay. All right. So bumili tayo ng raw material. On day 22, magbabayad na tayo, di ba? Asan yung pambayad natin? Class. Can we pay? Theoretically, can we already pay? Take a look at your timeline. Yes or no? Anyone please? Volunteer na lang kasi magta-time na tayo. Can we already pay, guys? Yes or no, please? Anyone would like to answer that? Raise your hands, please. Take a look at the timeline. Andyan yung answer. Andyan. If you understand the concept of operating cycle, can we already pay? Answer, please. Almost time. The answer is choice. No or no, guys. That's our option. No or no? No, of course. Thank you, Sherwin. Ang bilis talaga ni Sherwin. Bilib ako kasi, saludo ako siya, my friend, no? Ang bilis. No or no? Of course, no. Hindi pa. Bakit? Kasi dito pa tayo. We will be able to collect only here, right? This is your DP, this is your operating cycle. We will be able to collect on our receivables at day 134. However, we will have to pay our payables, our suppliers on day 22. Okay. One quick question. How many days will it take us to finance? Okay, sorry. What do we do? Because we can't pay yet. We can't pay yet. Theoretically, the cash will be coming here, 134. But we have to pay already day 22. So what can we do? One remedy can be to borrow. Okay? Borrow tayo ng short term. Question, how many days will it take us to finance the loan? Kasi manghihiram tayo eh. How many days will it take us to finance the loan, class? How many days? Okay. Chat, please. Or unmute yourself. It's already also here, guys. It's here. How many days will it take us to finance the loan? 6. Okay. Another guess, Sherwin? Let me give you a guess, class. What is in row 102 here? Row 102, Sherwin. Row 102. It's your class, it's your okay. It's your cash conversion cycle. Bakit? We will be borrowing here day 22, right? And we will be able to pay here on day 134. It means that your utang, your loan, is still open for 112 days. There. So the cash conversion cycle is the number of days it will take us to have our loan for the payment of our payables financed. So this is the number of financing days, 112 days. And we know that the higher the financing days, the higher will be the interest expense, because we know that the interest expense is a function of your time, right? We learned that in the first few days of first few sessions. Ang interest natin is dependent on time. The higher the time for the term of the loan, the higher will be the interest. Okay? So this is your cash conversion cycle. Okay, and the cash conversion cycle of our competitor is how many days? It's only 46 days. Okay, it takes the competitor only 46 days to have their financing. Okay, what's the meaning of CCC equal to 0? Is this a good scenario? compared to having 112 cash conversion cycle. What's the meaning of CCC is equal to 0? Class, come on, it's time. May I have last 2 minutes, class? What's the meaning of cash conversion cycle equal to 0? Remember, this is days payable outstanding, okay, or sorry, operating cycle minus DPO. So if this is 0, it means that your operating cycle and your DPO are the same. Diba? So nagmamatch lang yung pag-collect natin ng receivables natin at saka ng DPO. Okay, which is an ideal situation. Gusto natin na by the time we're able to collect on our sales, magjuju pa lang din yung yung DPO natin. Okay, and lastly, what's the meaning of a CCC? That's negative, let's say negative 150. Ano ibig sabihin nun? Ibig sabihin nun, class, okay, our DPO is here. DPO. Ang DPO natin, sabihin natin 180. Okay? And our operating cycle is 30. Okay, in this scenario, your operating cycle is 30. OC minus DPO, that's your cash conversion cycle. So that will be 30 minus 180. That means our CCC is 150. Okay? All right. So let me stop there kasi this is, I will review this concept yung DIO, DSO, DPO next meeting on Tuesday because this is very important. Kasi may gusto kong i-discuss about this. Ano yung implication ng negative 150? Ibig sabihin nun, andito na yung pera. Pero yung babayaran natin dito pa. Diba? So may libre tayong number of days bago pa tayo magbabayad ng, kasi DPO to eh. Diba? May libre tayong 150 days to do something with the money first. Okay, is that an ideal situation? Okay, so we'll continue with that next meeting. Okay, so let me stop recording.